In 2019, Gillette's billion-dollar brand was hit by backlash, write-downs, and a crisis of identity. Yet Wilkinson Sword survived almost untouched. Why did Wilkinson's old-world engineering and conservative strategy shield it, while the industry's giant spiraled? Beneath the surface of the razor wars lies a surprising answer that challenges everything you think you know about brand power. In 1772, Henry Knock opened a small workshop in London, crafting gun locks with a level of precision rare for the era. His reputation for technical ingenuity quickly grew, and by the time the American Revolutionary War began, Knock's firm was supplying the British military with bayonets and the distinctive 7-barreled volley gun. Each piece was tested beyond battlefield standards, setting an early precedent for quality assurance. After Knock's death in 1804, the company passed to James Wilkinson, who expanded its reach. The appointment as gunmaker to King George III that same year reflected not only royal favor, but an endorsement of engineering skill. When Henry Wilkinson, James's son, joined the business, he introduced sword production in 1824. Henry's background in science and engineering shaped a rigorous approach to metallurgy and testing. The company's éprouvette machine, developed in the mid-19th century, subjected blades to stress tests that simulated years of use in seconds. This relentless focus on materials and performance would anchor the company's identity for generations. By the late 19th century, Wilkinson Sword was producing thousands of swords and bayonets, its name synonymous with reliability on the battlefield. The move into razors and personal grooming would come later, but the foundation, an unwavering commitment to engineering excellence, was already in place, quietly setting Wilkinson apart from rivals who chased trends or relied on mass advertising. By the turn of the 20th century, shaving routines across Europe and North America followed a practical rhythm. Barbershops were fixtures on city streets, their chairs filled with men seeking a close shave and a steady hand. At home, the safety razor was gaining traction, prized for its reliability and ease of use. Wilkinson's Pall Mall patent roller safety shaver, introduced in the late 1890s, reflected a market where the main competition centered on blade sharpness, durability, and material quality. Stainless steel and brass blades sat behind glass counters in chemists and general stores, while barbers relied on tools chosen for longevity rather than style. Advertising, when it appeared, was understated, focused on the promise of a smoother shave or a longer-lasting edge. Product packaging highlighted technical features, not lifestyle aspirations. Shaving was regarded as a matter of personal upkeep, not personal identity. The expectations were clear. A razor should perform its function, last through repeated use, and offer value for money. This utility-driven culture shaped the early razor market, setting a baseline before the arrival of mass-market branding and the fierce battles for consumer loyalty that would follow. On January 14, 2019, Gillette released an ad titled, "We believe the best men can be across digital platforms." Within hours, headlines from the Wall Street Journal, BBC, and New York Times described a wave of public reaction. Social media feeds lit up with hashtags like #BoycottGillette, and users posted photos of razors tossed into trash bins. The campaign's YouTube video surpassed 28 million views in the first month, drawing over 400,000 comments, most of them negative. On Twitter, sentiment was sharply divided. Brandwatch and Commetric analyses showed that while tweets from verified accounts leaned positive, the majority of replies with high engagement expressed anger or called for a boycott. Morning Consult's survey of 2,200 adults painted a more nuanced picture. 61% viewed the ad favorably, but among frequent razor buyers, intent to switch brands rose measurably in the weeks that followed. Academic studies tracked the campaign's impact in real time. On YouTube, negative sentiment outpaced positive by nearly 2-to-1, with backlash concentrated among men aged 25 to 54. One marketing professor described the response as a textbook case of polarization, amplified by the viral spread of outrage. In news interviews, Gillette's parent company spokesperson defended the campaign's message as socially responsible, citing high engagement and increased brand visibility. But analysts noted that spikes in online activity did not translate to immediate sales gains. Internal sentiment dashboards, later cited in trade publications, recorded a 10 to 15% decline in brand favorability during the first quarter of 2019. By March 2019, industry sentiment charts showed Gillette's Net Promoter Score falling, while direct-to-consumer competitors like Dollar Shave Club and Harry's reported upticks in trial signups. The wave of reaction, measured in headlines, hashtags, and sentiment graphs, became impossible for executives and investors to ignore. As the quarter closed, marketing risk experts pointed to a clear causal link between the campaign's cultural flashpoint and the volatility now visible in the brand's key performance indicators. Dollar Shave Club launched in 2012 with a promise that upended industry economics, quality blades delivered to a subscriber's door for a fraction of the price. Within 2 years, the company's viral marketing and direct-to-consumer model had drawn millions of customers away from legacy brands. By 2016, Unilever acquired Dollar Shave Club for $1 billion, a figure that stunned market analysts and signaled the seriousness of subscription disruption. The impact rippled through the sector. Gillette, long the global leader, found its dominance under siege, not just from new competitors, but from a new way of buying altogether. Earnings calls from Procter Gamble, Gillette's parent company, began to include phrases such as volume softness, competitive intensity, and consumer value-seeking behavior. In fiscal year 2019, Procter Gamble disclosed an $8 billion impairment charge against its grooming segment, citing both lower-than-expected sales and a permanent shift in market value. The company's filings referenced direct-to-consumer threats by name, and quarterly results showed razor volumes falling by as much as 10% year-on-year during the height of the disruption. Sell-side analysts reviewing these disclosures on investor calls pointed to a sharp decline in repeat purchases and a growing willingness among consumers to try new brands. For the first time in decades, price sensitivity was outpacing loyalty in the grooming aisle. Meanwhile, Dollar Shave Club and Harry's reported double-digit growth, fueled by subscription renewals and aggressive trial offers. Charts from industry trackers depicted the shift in stark terms. Legacy brands' market share eroded steadily from 2012 onward, while direct-to-consumer upstarts captured nearly 15% of the United States razor market by 2019. The new economics of shaving, recurring revenue, flexible pricing, and digital engagement forced incumbents to reconsider long-held assumptions about distribution and brand power. Wilkinson, with its measured approach and lower exposure to subscription churn, would soon stand in sharp contrast to the volatility now gripping the rest of the industry. Edgewell Personal Care's approach to managing Wilkinson Sword stands in stark contrast to the volatility seen elsewhere in the razor industry. While competitors rode waves of public sentiment and marketing risk, Edgewell's leadership relied on a measured, data-driven strategy. In 2020, Edgewell's attempt to acquire Harry's, valued at $1.37 billion, was halted by the Federal Trade Commission, FTC, which cited concerns over reduced competition in men's grooming. That FTC decision not only blocked consolidation, it also preserved the independence of Wilkinson's parent, keeping its risk profile distinct from the turbulence facing larger rivals. Investor dashboards from the period highlight 3 key performance indicators that set Wilkinson apart: brand loyalty retention, consumer churn, and price elasticity. According to Euromonitor, overall razor brand loyalty in the US dropped by 15% between 2015 and 2022, with Gillette's loyalty rate declining from 70% to 55%. Wilkinson, under Edgewell, saw a much smaller decline. Loyalty dipped by just 5% over the same period. Internal churn metrics reported in Edgewell's annual filings remained stable at 2 to 3% per year, compared to 7 to 9% churn rates documented at major competitors during the height of direct-to-consumer disruption. Price elasticity, another critical measure, revealed further insulation from market shocks. While Gillette's price elasticity spiked above 1.0 after its 2019 campaign, indicating high consumer sensitivity, Wilkinson's stayed below 0.8, reflecting a core customer base less likely to switch brands over price or cultural messaging. Executive key performance indicators tracked by Edgewell's board emphasized these trends, with quarterly reports noting minimal volatility in grooming segment performance and stable market share despite category disruption. A corporate structure diagram from Edgewell's 2021 investor presentation illustrates Wilkinson's role as a steady performer within a diversified portfolio. The company's risk-averse branding and operational discipline shielded it from the sharp swings in sentiment and sales that defined the era. As loyalty charts and KPI dashboards make clear, Wilkinson's resilience was not a matter of luck, but the outcome of deliberate choices made at the highest levels. In a market where brand loyalty fades and backlash can erase billions, stability is a rare advantage. Wilkinson's restraint isn't just history, it's strategy for an era of volatility. Sometimes, survival means knowing when not to go to chase the crowd. What risks do today's brands still ignore? Share your thoughts below.